The one that has a lot of women. I say that is going to be.
All right, guys. So let's continue.
Oh yeah, he's right. He's right. It's a family thing. It's a legacy.
All right. So when it comes to cost, volume, profit analysis, here we're looking at both, or let me say, all three of those aspects and how they influence the profitability of the company. Okay, obviously, if we reduce our costs, that means that we have more profit. If we increase our volume, and this is volume of units that we've sold, all right, then we assume, and we assume all other things remain constant, okay? Then likewise, we should then obviously increase our profits, all right? And then, so that's what we typically are looking at when it comes to cost volume profit analysis. Here they're calling it relationship, all right? So we look at each of those different components, and you can think of this is very closely related to your sensitivity analysis, all right? Where we say, okay, cool. If we also discount the price of our product, how many more units are we going to sell? Okay, that's all what we're looking at in relation to that. But then also very important in conjunction with this is that we're looking at break even, all right? And break even, we know, is the point at which we are neither making a loss or a profit. It's where our costs equal our revenue, okay? And we always want to know this because then we know how many sales we need to make sure that we do or cover in a certain period of time, whether that is a month, a year, weeks, or whatever the case may be. Usually, whenever we're talking break even, we're talking about over the course of the month. Okay. Right. But let's proceed. Okay. So here now, they're further looking at your break even. All right. And this is the formula for calculating break even in terms of number of units. Okay. So you've got your fixed costs divided by your marginal income, which we ascertain by saying your selling price per unit minus your variable cost per unit. Yes, sir.
So the fixed cost on top of formulas for all the fixed costs in total.
For all the fixed costs, yes. For all the fixed costs for that period. So again, usually we're talking about the fixed costs for the month. Okay, right. So these are things you don't need to cram, but you must understand. Okay, so your selling price minus your variable cost obviously gives you your marginal income per unit. Okay, or here they're calling it your variable profit. Okay, right. And there graphically, you can see your break-even point. The number of units that you need to produce and sell in order to ensure we're neither making a loss. Here you can see shaded before that point where the total cost line and your total revenue line, sorry, total income line and your total cost line cross. Before that point, the whole shaded point is where we're making a loss. Okay, so we would then immediately know, let's say Y is 20 units. We would immediately know anything below 20 units, we're making a loss. Anything past this point, we're making a profit. So worst case scenario, let's make sure that we at least produce and sell 20 units, okay? Then here, now we move on to the story of time value, okay? And earlier I mentioned that when it comes to time value, we're just acknowledging the fact that money today is not the same as money a year from now, for example. And why is that the case? Every few months, every quarter, Stats SA tells us about something. in reference to the increase of prices. What is that called? Inflation. And what is inflation? It's the erosion of the value of our money, isn't it? The increase of prices of goods and services.
So you give us two definitions
For
for inflation.
yes,
So the first one is so the erosion of the value of our money.
yes,
Second one is overall increase in the price of goods and
100%. So the second one is the textbook definition that you'll find. The first one is the more practical, because we're actually just saying the same thing in reverse. One, we're saying when looking at the price of our products, price and services of our products, they've increased. We noticed that last year, a loaf of bread was, let's say for argument's sake, 10 Rand. This year, we see it's what? 13 Rand. The price of the good has increased. Now, the initial one, we're saying, okay, what does that mean for my money? I had 100 Rand last year. It could buy me more. I have 100 Rand this year. What is it doing for me now? It's buying less. So can you see my money has eroded? It has lost value, 100%. Okay? So it's the same thing. But again, the correct one, if they ever were to ask you that, is inflation is the increase in value of prices of products and services over time. Isn't it? Right. Okay. So that's where now this concept of interest now comes into play. So if you borrow me money, you borrow me 100 Rand, am I paying you back 100 Rand? Because knowing that inflation takes place. So from a year from now, would you be willing to accept 100 Rand as it is? No, you're going to charge me interest. And if we're to define interest, interest literally is just the cost of borrowing money. Okay? It's the cost of borrowing money. And the higher your interest is, the more expensive the cost of that money. Okay? And when we talk about cost of capital, we're actually referring to interest. Okay? Right. So now we've got these concepts here called the future value and the present value. Have you guys ever stumbled on these things? Future value and present value in relation to money.
is
In what subjects have you guys touched on?
I think it makes sense in economics.
In economics. Did you guys actually do it in economics?
Each year
Oh,
in high school.
in high school. In math. Okay, so these concepts are not completely foreign, right? If any of you, okay, I know you guys are BCom law students, but if any of you ever were to study, what you call this, investments, this is pretty much what it's all about. Okay, so that's actually where my background lies. But future value is basically taking this 100 Rand and saying what is the value of 100 Rand based on a certain compounding rate, which is just an interest rate that we are growing the money by between now and 5 years from now. Present value is saying 100 Rand 5 years from now. What is the actual value today? So present value is saying currently, present, what is the value of this amount of money? Does that make sense? Future value, we're saying sometime in the future. Okay, this is the value. Okay, so those are the concepts there. And then here there's a nice little graph depicting what I've been saying. Present value, here now. You can see there time zero. T0 is time zero. Right? Time now. Okay? Then passage of time. Now, future value. Let's look at the top part of the graph for now. We compound whatever amount, 100 Rand. 5 years later, what is the value? Okay? By whatever interest rate. Okay? Then, if we wanted to bring back a value, so let's say we've got a retirement annuity that pays us 10 million, 20 years from now, if we want to say what is the value of that 20 million today, right? How many years did I say? Did I say 10 or 20? 10 years. So we're discounting that 10 million back to present day, okay? And the interest rate is called the discounting factor, all right? Or your discount rate, okay? In order to get the value of that present value. So here you can just see the relationship between present value and your future value. Okay, and here now they're just speaking to the things that we've obviously been highlighting, all right? So here, future value of an initial investment or principal is determined by means of compounding, okay? Amount of interest earned in each successive period is added to the amount of the investment at the end of the preceding period. So what they're trying to say there is at the end of year one, remember we said we're investing 100 Rand over 5 years. Let's say that we're investing at an interest rate of 10%. 10% per annum. Okay, I'm going to make the math very simple so that you guys don't fall asleep coming out. But after 1 year, 10% on 100 Rand, how much do we have? We have 110. You agree? Yes? Very relevant question. Very relevant question. So remember I don't think they have they do, it is compounded. But here they don't go into the different compounded period. So you can have remember I said per annum. So the compound is actually per annum. That makes sense. So we can have compounding per month. Okay. So, and that is going to result in different levels of interest, which is what she's asking. All right. So, in the first year, either way, whether it's simple or compounding, for the first we will then earn interest on not 100 Rand in the second year, but 110 Rand. So can you see we are getting interest on interest? And that's the concept that they're trying to highlight there. Okay. Interest is therefore earned on capital and interest in each successive period. Simple and plain. Now, if you want the formula for the future value, it's this right here. Okay, and this is compounded. Okay, but I think they don't get too technical with you guys, so you need to worry too much. But very brilliant question. Very brilliant question. Maybe to play it safe, né? Let me say, let's look at some questions first. But I don't imagine that they do. I think here in business management, they're just trying to highlight what is going on within the sphere of financial management. And obviously, as a financial manager, this is what you will typically be playing with when deciding on whether to invest in something or not to invest in something. So I don't imagine that they go that deep. So here you're doing the same thing. You're looking at now the discounting process. And here's your formula for how we calculate the present value. You'll see that you've got the same variables in this formula. All right? You've got the same variables, but obviously the formula is adapted a little bit. Okay? Because remember, we're doing the opposite. In the initial one, we were trying to grow your investment with time. Here you're trying to obviously bring it back to present day, which would obviously decrease the value amount that you would obviously then have. Okay. All right. So here now they're just talking to financial analysis, planning and control. Okay. Financial analysis is necessary to monitor the general financial position of the business and to limit the risk of financial failure of the business as far as possible. Now, the reality is we are always looking to manage risk in business because we know by virtue of engaging in business, we are taking on risk. But how do we survive? By obviously managing that risk, ensuring that it does not get ahead of us, all right, or overcome us. And this is why we pay insurance. So that when unfavorable events take place, we are obviously covered by Old Mutual or Discovery or Momentum, whoever our insurer is. But here now, we're talking about it from a financial perspective, and we're saying that we have to do our analysis so that we can see what's our financial position. In seeing our financial position, we can see, are we at risk of failure or are we in a good position? Okay, that's the whole concept there that's being shared. Now, financial managers have a number of tools at their disposal to conduct financial analysis. We've spoken about the balance sheet or the statement of financial position. We've spoken about the statement of financial performance, income statement, as I like to call it, or your profit and loss. Then we've got financial ratios. Ooh.
So,
yes.
I have a question before we continue.
Yes.
Everything that you are discussing right now, does it fall under the, is it a risk management function or is it a different chapter?
This would fall under financial management, but it is related to risk management. Because with risk management, you are basically looking at the probability of certain outcomes, certain events taking place. And then based on that probability, you're saying, if there is an 80% chance that there's going to be a, what do we call this? A recession. What do we need to put in place to ensure that this business survives a recession? Because we know if a recession does take place, we know that obviously we're not going to make as much sales. And if we don't make as much sales, how are we going to cover our expenditure? Okay, so it's very closely related. Makes sense? Okay. If anything, they kind of are intertwined to some degree. But yeah, with risk, you are literally looking at ratios, probabilities of certain outcomes and stuff. Yeah. Okay, so here again, they're just showing us our income statement. There you go. Yeah, that's your income statement. I won't even dwell on it. Statement of financial position, right? Okay, and you know, the format of these things changes a lot depending on which textbook you're looking at, depending on whether you're in high school or in tertiary, and also whether you're in America or you're here. But at the end of the day, the core stuff, assets, liabilities, income, and expenses, you will find in all of it. Okay? So at their core, they are the same. Now, this is what I want to dwell on because at the end of the day, you guys are familiar with your income statement and your profit and loss. Or should I say your statement of financial positioning? You guys are familiar with those. Now, but ratios are a snapshot of what is going on in the business. All right? Especially depending on what ratio you are looking at. All right? So they are a quick and easy way to assess how are we doing as a business. So if you were actually into finance, all right, this is where you would play. Accountants do the bookkeeping. They do the statements. As a finance graduate, you or a finance professional, you would interpret your financial statements, look at ratios, and then give an assessment, an analysis of how is the business doing. All right? Based on also the industry and so on and so forth. So here they're saying ratios, a financial ratio gives the relationship between two items or groups of items in the financial statement. Serves as a performance criterion to point out potential strengths or weaknesses of the business. And then here they start breaking down the different types of ratios that you get. So liquidity ratios, we're talking about, when we talk about liquidity, what are we talking about? Maybe let's start. And you guys can read what's on the board, but talk to me. What is liquidity?
That's how much running a business is, or how long to keep the business running, or the money that it is.
It's both, all right? Both of you are 100% correct. How much cash do we have at hand? All right, and we are assessing this because we want to know, can we meet our expenses? Okay, if we're not liquid, that means that we have money tied up in stuff, and that means that if we have an unforeseen expenditure that we need to obviously meet soon, we're going to have to start selling off assets or taking on financial loans in order to meet that financial commitment, which in the long run is going to be problematic. Because if we sell a printer that we actually need to use on a daily basis, how are we going to print when we need to print? Does that make sense? If we sell the delivery vehicle in order to get some quick cash, then when we actually now need to do deliveries, can you see it disrupts our business? So we want to be liquid so that we can meet our business activity expenses as and when they fall due. Okay? You want to say something? Sorry, I just want to finish my thought.
No, but I saw it, but it's fine.
Okay. So here now, it actually says, indicate the ability of a business to meet short-term obligations as they become due without, sometimes you think that, and ceasing normal activities. Okay. So here you've got the current ratio, which is literally your current assets divided by your current liabilities. Okay. You know, current assets, we're talking about all of our short-term or near cash assets. Okay. So that would be your inventory. You're talking about the actual cash you have in the bank. You're talking about the cash you have in the petty cash. All right. And if you have float, which is the money in the till. Okay. Now, usually you want a ratio of 2:1 here. All right. It's also dependent on the industry you're in, because certain industries need cash on hand a lot more than other industries. Does that make sense? So you're always considering also the industry when you're doing your financial analysis. Then the asset test ratio, also known as the quick asset test ratio. Okay. There you're actually removing your inventory. Because remember, what you must understand is inventory or your stock is something that you are waiting to sell. Does that make sense? So if you don't sell it, then you don't have cash. All right? And the reality is you might be stuck with a whole lot of inventory that you're struggling to sell. So if we want to buy a business, we want to assess how liquid it is. We then are going to check the asset test ratio, or the quick asset ratio, so that we can see how liquid this business is. Okay? Because remember, you might be profitable on paper, but if you can't meet your financial obligations, you're going to close them. If salaries fall due, but there's no cash in the business, you're going to close down, regardless of how profitable you are. Okay. Then here now they're talking about the solvency ratio. And solvency ratio, we're basically saying what is the business's ability to meet its long-term debt. Okay. So there you can see you've got your debt ratio, which is your total debt divided by your assets. Okay. The higher these ratios are, let me say the debt ratio, the higher the debt ratio is, the more leverage, in other words, the more money we have borrowed to fund the business's assets, which means that in hard economic times, this business is very risky. Because if people stop buying the services, buying the products of this business, what's going to happen? There's going to be a whole lot of debt and no money to pay off that debt. Okay. Then talking about the gearing ratio, again, where we see how committed owners are to their business based off of how much capital they put in. So again, in this one, the higher it is, the better. Because we're basically saying there is a lot of equity that the owners have actually put in the business, right? So that's actually what we want. The lower it is, the more concerned we are, because we're basically saying we funded this business by debt, and if everything goes to nothing, then the the banks that have financed this business will have huge losses in comparison to the losses that the owners will obviously incur. All right. Now here they're talking about profitability ratios, and profitability ratios as potential investors in a business. This is definitely what you'll be looking at. You want to know what is your gross profit margin? How much return do we get on the products and services that are being sold? What is the net profit margin? What is the net profit percentage on this business as a whole? Return on the capital that we put in the business. What is it? How much return are we managing to generate off of the money that we invested in it? Okay. Return on owners' equity. All right. The money they've invested as owners, what is their return looking like? Is this an attractive business? Okay. Right. So now here they then go on to talk about financial planning and control, but we will stop here for today. Okay. We will stop here for today. Are there any questions or thoughts? Yes, ma'am. I haven't seen any questions yet in relation to this letter, so I can't say yes or no. I can't say yes. But I think what's important, guys, she's asking a very relevant question. Do you need to know these formulas or not? I think one thing for sure is you must be able to explain what are we looking at when we talk about solvency ratios, at the very least, when we talk about liquidity ratios, when we talk about profitability ratios. What are these things? What are we assessing from an overall perspective? At the very least, you should be able to communicate them. Okay. Right. Has everybody signed the register? Okay. I haven't received all of your question paper answers. I think there's maybe 7 groups. So that means I'm missing 3. You're disturbing him, guys. Let him rest.